So the question says the following information was extracted from the financial statement of Happy Limited. We have the income statement for the year ended 30th June 2017. So from the income statement, we are interested with the profit before tax and interest. And we have the statement of financial position, whereby we have the non-current assets. We're given the PPE, that's property, plant, and equipment. Then for the current assets, we have inventory, accounts receivable, and bank balance. So on that, we will calculate or determine the changes in working capital, except on the bank balance, which we will treat it or classify it under the cash and cash equivalents. We have equity and liabilities. We will check whether we have any issue of shares. We check whether we have any issue of shares, and also we check whether we have any acquisition of loan or payable paying of loan, and also the current liabilities. Current liabilities, we have the accounts payable. We'll determine the changes in working capital. For the proposed dividends and the tax payable, we'll determine the dividends payable during the year and also the tax payable during the year. Additional information: one, we are told that PPE was classified as follows. So we have been given the balances as at the beginning of the year, that is 1st of July 2016. But we are given the closing balances of 30th June 2016. That means they were the opening balances as at the beginning of the year of 2016-2017. So the given balances there, the given balances, we are just being shown how the balances reported in the statement of financial position, they were obtained. We're just being shown how they were obtained. So the PPE was classified into property and plant. It was classified into property and plant. Then we have number 2. We are told that plant disposed of during the year ended 30th June 2017 had an original cost of 18,200,000 and accumulated depreciation of 6,300,000. So we will determine what was its carrying amount or the net book value before it was sold. Then we check on the disposal proceeds, which amounted to 5.11 million. And now we will determine whether it was sold at a profit or at a loss. Then we have the final information. We're told that the dividends were declared before the year end. The dividends were declared before the year end. So that is an information to help us to determine the dividends which were paid during the year. Required is the statement of cash flows according to the IAS 7 for the year ended 30th June 2017. So we have Happy Time Limited. This is November 2017. That is question 3B. Question 3B, statement of cash flows. For year ended 30th June 2017. So we start with the operating activities. We start with the operating activities. The operating activities where we record the profit before tax and interest. The profit before tax from the income statement, we have been told it is 17,752. We add the interest paid, which is the finance cost. Finance cost is the other name for the interest, 868. So this, the profit before tax. Profit before tax is 25,032 and 32. 25,032. That's the profit before tax. Then the interest, which is also known as the finance cost, is 832. Is 832. So this will give us an amount worth of what? These figures are in thousands. This will give us 25. It will give us 25,900. That's all. 25,
Yes.
25,900. 25,900. Then, before we continue and determine what should we add, let's see whether the PPE which was sold or the plant which was sold, whether it was sold at a loss or at a profit. At a loss or at a profit. So we have the PPE, the plant sold. Before it was sold, the net book value as at the date of sale will be the cost, which is 18,200 minus 6,300. So what was the net book value before it was sold? How much?
11,900.
11,900. 11,900. Then we are told that it was sold. It was sold for 5,110,000. So the proceeds. It was sold for 5,110,000. So before it was sold, it had a value of 11,900, but now it has been sold at 5,100,000. That means it was sold at a loss. It was sold at a loss of how much? It was sold at a loss of 6,790, right?
Yes.
6,790. So we'll come here and add loss on disposal. Loss on disposal. This is an non-cash. It's a non-cash expense. 6,790. 6,790. Then also we will calculate and see whether or determine whether the whole PPE had depreciated. The whole PPE, whether it had depreciated. So the PPE account. For the PPE account, we have the balance drawdown. The balance drawdown is at the year 2016. As at year 2016, which is 101,500. Then the balance carried forward, we're given as 127, 120, 127, 120, 127, 120. Then we have a plant which was sold, disposal, and before it was sold, it had a net book value of 11,900. It had a net book value of 11,900. Then we can under the equity and liabilities for the capital and reserves, we have revaluation reserves. We have revaluation reserve. We have revaluation reserve. We have the revaluation reserve. So for that case, revaluation reserve is at the beginning of the year was 0, but now we see as at the end of the year, that is 2017, is 3,500. It is 3,500. It is 3,500. 3,500. Let us determine whether the question mark given there, whether should be 0 or should be what. Let us determine that. So take that 5,000, have that 5,000 plus 19,705 plus 54,705 plus 30,800 plus 23,100 plus 14,595. That is a total of what? Yes, Christine?
Pardon, what are we adding?
I've said under the revaluation reserve given in the statement of financial position at the beginning of the year in question mark. All right?
Yes.
Yes, so we want to know whether it was 0 or it was how much. That's why we are adding the all amounts, the all of the totals of the items given there from share capital up to the liabilities, so that we can know whether it's giving us 123,200. Okay?
Yes.
Yes, so we have that 5,000 plus 19,705 plus the 54,705 plus 3,800 plus 23,100 plus the 14,595. How much is it giving us?
$177,905.
177,905.
Yes.
177.
Yes.
That is more. That is, we only add in from the share capital from that 5,000. From that 5,000 plus 19,705 plus 54,705 plus 20, that is 3,800 plus 23,100 plus 49,595.
Yes, it is giving 177,905.
77.
Yes.
77, not 177, eh?
177,905 up to tax payable.
Up to tax payable.
Yeah.
Have you added the current liabilities kando kando ama umechukua zote pamoja? The current liabilities is the total of 14,595, eh?
Yes, I've taken the total. I've taken 35,000, 19,705, 54,705, 3,800, 23,100, 14,595.
Then
595.
49,95, 595. That means the value is more. Those values are more. Oh, sorry, minus the 54,705. That is a total of equity. Sorry. Minus the 54,705. Minus 54,705. It is a total of the share capital and the share premium. So that total minus the 54,705 in our banking ngapi?
123,200.
123,200. That means that valuation at the beginning of the year it was 0. Okay.
Yes.
Yes, and here that means that PPE was revalued upwards with that 500 revaluation. That 500. Then we will determine the depreciation for the year. So we draw the provision for depreciation account. The provision for depreciation account. The balance brought down. We pick them from additional information 1. We have been given them there. Year 2017. We just pick the total. The total of 2016. The total of 2016 was 32,900. Then the total year 2017 is 45,080. Then we have the plan which was sold. It had a depreciation of 6,300. So we had accumulated depreciation on disposal. Of 6,300. So we can determine now the depreciation charge for the year. the depreciation charge for the year. So this is 32,900 plus 6,300. That is giving us 39,200 minus from 45,080 to give us a value of how much?
$5,880.
5,880. So that was the depreciation for the year. We come back to the PPE account and record depreciation here. 880. So now we can determine whether they purchased or they sold. Determine whether they purchased or sold. Determine whether they purchased or sold. Let's see what happened. Whether they purchased or what happened. So this side will appear to be more than this. That means they purchased some PPE. They purchased some PPE. So 11,900 plus 5,880 plus 127, 120. We minus the 1,500 minus that 500 to give us a figure of how much.
$39,900.
Yes?
39,900.
39,900. 39,900. 39,900. Right. So now we have noticed that they purchased some PPE. So we'll have purchase of PPE, and now we have depreciation. So we go back now to the statement of cash flows and record depreciation. We add it back. It's a non-cash expense. Depreciation 58,80. 58,80. So from there, we do not have any non-cash income. There were no profits on sale. So from there, we can do the changes in working capital. Do changes in working capital. The changes in working capital. Here we say that increase in current assets with less, decrease we add, then increase in current liabilities we add, decrease we less. So we go to the current assets and see what happened to the inventories. So we have an increase in inventory, that is 11,200 minus 7,700. That is giving us how much?
$3,500.
Yes.
3,500.
That is 3,500 we less. We also check on the accounts receivables. It also increased from 5,600 to 10,500 increase in receivables. 10,500 minus 5,600. These ones increased with
4,900.
4,900. So an increase with less. For the bank balance, that one will transfer it under the cash and cash equivalents as we finish the statement. So we go to the current liabilities and pick the accounts payable. We pick the accounts payable from 5,600 to 4,900. That's a decrease. That's a decrease. Decrease in payables. Decrease in payables. Decrease in payables. From 5,600 to 4,900. So it decreased with how much?
700.
Decreased with 700. Decreased with 700. So that's a decrease in liabilities with less. With less. Then from there now we can determine the tax payable. From there we less the tax paid during the year. And for the tax paid, we have the tax payable as at the beginning of the year, given in the statement of financial position, which is 4795. Then during the year, on the profits that they made, they were charged a tax expense of 7280. So that means that at the end of the year, this should be the total tax payable. This should be the total tax payable. But if you look at the statement of financial position for the year ended 2017, the tax payable is 7,280. 7,280. That means they paid how much? They paid 4795. They paid 4795. Yes. So this will give us, or the total of that will give us the net cash flows from investing.
Excuse me.
Yes.
Can you kindly repeat on the tax paid?
I've said to determine the tax paid, you take the tax payable as at the beginning of the year, which is 4795, right? It's given in the statement of financial position under current liabilities, 2016. We have the tax payable.
Yeah.
Right?
Mm-hmm.
Then we add the tax which was charged at the year profits during the year. The tax now charged in the income statement. We add the two, okay?
Yes.
The tax charge in the income statement is 7280.
Yeah.
All right, so that means at the end of the year, they should pay a total of 4795 plus 7280. Okay?
Yes.
Yes, but now it's at the end of the year, that is 2017. We already seen that they are supposed to pay 7280. That means that they paid at least some. They paid part of that tax. This is the one which is remaining, the tax payable. That means it is due. So if you take 4795 plus 7280 minus 7280, you remain with what? 4795.
Yes.
Yeah, so we can have the net cash flows from the operating activities. From the operating activities. So we add from top, then we minus those items. Then from there we go to the investing activities. So how much are we having as the net cash flows from operating activities?
$24,675.
24,675. Positive, negative?
Positive.
Positive. 24,675.
Yes.
All right. Then we can continue and record the investing activities. We said that investing activities, we record the purchase of non-current assets, sale of non-current assets, either investment income, interest income, or dividend income. So in this case, we see whether there was purchase of any asset And we saw from the PPE account that there was purchase of part of the PPE, purchase of the PPE. They purchased that 9,900. This is an outflow. Every outflow we less, it's an outflow. That's an outflow. And also we saw that there was sale of plant. In additional number 2, we have the proceeds from sale. Proceeds from sale of plant. Proceeds from sale of plant. This is an inflow. They received 5,110,000. 5,110,000. 10,000. And there's no other item affecting the the investing activities. There is no income related to investing. So with these two, we determine the net cash flows for investing activities. From investing activities. So that is 39,900 minus the 5,110,000. So here we remain with a negative of
790.
790. 790. Then now from there we can do the investing, not investing but financing activities, the financing activities. The financing activities, we check whether there was issue of shares, acquisition of loans, payment of loans, payments of dividends, payment of interest. All those, we factor them in here. And if you look at the share capital, we will see that there it increased, meaning there was issue of shares. And also if you look at the share premium, it also increased, meaning that those shares which were issued, they were issued at a share premium. That is at a price higher than the par value. So the increase in the share capital is 45,500 minus 35. So that's an increase of 10,500. Then the share premium increased with how much? 26,838 minus 19,705. Give me the difference. Give me the difference.
7,133.
7,133. 7,133. Then we get the total. We have the increase in the share premium plus the increase in the share capital. This is the total amount that they received from the issue of shares. So this one will give us how much? 17,633. And that is an inflow. That is an inflow. Then we check on loan. Let us check on the loans. Under the non-current liabilities. Under the non-current liabilities, we have the long-term loan. At the beginning of the year, it was 23,100, but now at the end of the year, it is 16,100. That means they paid loan. That means they paid loan, and that's an outflow. Repayment of loan. Repayment of loan. So they paid an amount of how much? 7,000. And that is an outflow with less. And also they paid the interest, the finance cost. The finance cost paid. The finance cost paid of 868. finance cost paid of 868. Then also we determine the dividends which were paid. Determine the dividends paid. So for the dividends paid, we take the dividends payable as at the beginning of the year. We take the dividends payable as at the beginning of the year. We add the dividends which were declared during the year. Then we add the dividend, we minus the dividends payable at the end of the year. Dividends, the dividends paid, we take the dividends payable, among the dividends proposed, they are those ones. The 4,200 as at the beginning of the year. Dividends payable at the beginning of the year, the proposed dividends, 4,200. Then we add the dividends which were declared during the year, 7,700. They are highlighted in the income statement. They are highlighted in the income statement, 7,700. So that means at the end of the year, they should pay dividends worth 11,900. But now, at the end of the year, we see that there are some dividends which are remaining outstanding, payable of 4,900 of 4,900. So we less, and that will give us the dividends which were paid during that year. So that is 11,900 minus 4,900 to give us 7,000, and that is an outflow. That is an outflow. That is an outflow. That's an outflow. So that is it. There's no other item affecting the financing activities. So we can get the net cash flows from financing activities. Net cash flows from financing activities. The net cash flows from financing activities. Net cash flows from financing activities. Net cash flows from financing activities. So we add from here, we have the 17,633 minus 7,000 minus 668, sorry, minus 7,000. So it will give us a net cash flow of how much?
$2,765.
2,765. 2,765. Then now from there we can add the three. We add the three of them. We take the operating plus the investing plus the financing net cash flows, and we get the net cash and cash equivalents. The net cash and cash equivalents. The net cash and cash equivalents. That is 7350. Then we add the opening balance of the cash and cash equivalents, whereby we add the bank balance. This is the opening balance. The opening balance we are given under the current assets. We had bank only. The opening balance is 8,400. 8,400. Then from there we get the ending or the closing. The ending or the closing balance. The closing balance we are given as 1050. We're given as 1050 is negative 350, negative 7,350 plus 8,400. Is it giving us 1050?
Yes.
All All right, so that is awesome. So that is the end of that question. That's the end of that question.